Here's something that catches many retirees completely off guard. The IRS has a deadline this April that, if you miss it, could cost you a penalty of up to 25% of money you were supposed to take out of your own retirement account. That's not a typo. Your own money you've worked decades to save, could be penalized simply because of a date on the calendar. If you turned 73 last year or you know someone who did, please stay right here, because what I'm about to share could save you thousands of dollars and a whole lot of stress. If this sounds important to you, and I promise you, it is, go ahead and hit that like button, subscribe so you never miss updates like this, and drop a comment below telling me, did you already know about this deadline? Now, let's take a breath and walk through this together, because I know tax rules can feel overwhelming, like trying to read a map written in a foreign language. But I promise you, by the time we're done today, you're going to understand exactly what this deadline is, whether it applies to you, and what smart steps you can take right now. Think of me as that neighbor who used to work at the IRS and is now sitting across from you at the kitchen table, talking straight. So let's start at the very beginning. The rule we're talking about today is called the Required Minimum Distribution, or RMD for short. Now, you've probably heard that term before, maybe from your financial advisor or perhaps from a letter you received from your bank or brokerage. The basic idea behind RMDs is actually pretty straightforward. When you contributed money to a traditional IRA or a 401k over the years, you got a wonderful tax break. You didn't pay income tax on that money going in. The government was patient. They let it grow. But they always intended to collect their share eventually. And that's exactly what RMDs are, the IRS saying, all right, it's time to start taking some of that money out so we can tax it. For most of your working life, you could leave that money sitting and growing untouched. But once you hit a certain age, the rules change. Under current IRS guidelines, that age is 73. If you turn 73 during the year 2025, meaning you were born in 1952, then April 1st, 2026, is what the IRS calls your required beginning date. That's the absolute last day you can take your very first RMD without facing a penalty. And I want to make sure that sinks in, because this is the heart of everything we're talking about today. Now here's where it gets a little tricky, and this is the part that surprises so many retirees. You might think, well, I'll just wait until April 1st, that gives me the most time. And technically, yes, that's allowed. But here's the catch that nobody warns you about: if you wait until April 1st, 2026, to take your 2025 RMD, you will also have to take your 2026 RMD by December 31st, 2026. That means 2 full distributions in the same calendar year. 2 big chunks of taxable income, both counted in 2026. Why does that matter so much? Well, think about it this way. Let's say your name is Harold, and you're a retired schoolteacher from Ohio. You've been careful with money your whole life. You have a comfortable IRA, you get Social Security, and maybe a small pension. Life is good and manageable. Now, if Harold takes 2 RMDs in 2026, suddenly his taxable income jumps significantly. That could push him right into a higher tax bracket, meaning more of his income gets taxed at a higher rate. And it doesn't stop there. Higher income can also trigger increased Medicare Part B and Part D premiums, something called IRMAA, the income-related monthly adjustment amount. So Harold could end up paying more for his health coverage too, just because of the timing of his withdrawals. It's a domino effect that catches a lot of good, careful people completely off guard. So how much exactly do you need to withdraw? I want to be really clear here. There is no single dollar amount that applies to everyone. Your RMD is personal to you, and it's calculated using 2 specific numbers. The first is your total account balance in all tax-deferred accounts, your traditional IRA, your old 401k(s), your 403(b)(s), as of December 31st, 2024. The second is something called the IRS Life Expectancy Factor. For most 73-year-olds, that factor is 26.5, taken directly from the IRS Uniform Lifetime Table. So if you had, say, $265,000 in your IRA at the end of 2024, you would divide that by 26.5, and your RMD would be $10,000. That's the amount you need to withdraw and report as income. Simple math, but only once you know the formula, and most people don't. Now, I know some of you watching might be thinking, does this apply to my Roth IRA too? And this is one of the most common questions I hear, so I'm really glad you're wondering about it. The answer is no, at least not for your own Roth IRA. One of the most beautiful features of a Roth IRA is that the IRS does not require you to take RMDs from it during your lifetime. The money can sit there and keep growing tax-free for as long as you live. So if you have a Roth, you can breathe easy on that one. RMDs apply to traditional IRAs, old 401(k), SEP IRAs, simple IRAs, and similar tax-deferred accounts, but not your own Roth. Here's another situation worth knowing about. Some of you might still be working at 73, and good for you, by the way, whether it's by choice or by circumstance. If you are still employed and participating in your current employer's 401(k), you may be eligible to delay RMDs from that specific plan until you actually retire. However, and this is critical, that exception only covers your current employer's plan. Any old 401(k) from a previous job, and all traditional IRAs, still require RMDs on the regular schedule. So even if you're still punching the clock, don't assume all your retirement accounts are off the hook. Now let me share something that I find genuinely wonderful, because retirement planning doesn't always have to feel like a burden. If you don't actually need the RMD money to live on, maybe you have pension income, or Social Security covers your needs, and this distribution would just create a bigger tax bill, there's a strategy called a Qualified Charitable Distribution, or QCD. Here's how it works: instead of the RMD going into your bank account where it becomes taxable income, you instruct your IRA custodian to send that money directly to a qualified charity of your choice. The distribution still counts towards satisfying your RMD requirement, but it never passes through your hands as taxable income. For 2026, you can direct up to $111,000 this way. So if there's a church, a hospital, a university, or a cause close to your heart, a QCD is a beautiful way to give generously while also managing your tax situation wisely. It's the kind of strategy that makes you feel good in more ways than one. Let's also talk briefly about a few other important April deadlines, because April 2026 is actually a pretty busy month for retirees from a financial standpoint. April 15, 2026, is the standard deadline for filing your 2025 federal income tax return. Now, many of you already know that date like the back of your hand. It comes every year without fail, like an old unwelcome guest. But what you may not know is that for the tax year 2025, there is a brand new bonus deduction available specifically for retirees aged 65 and older. It's a $6,000 deduction per person, designed to help reduce your taxable income. If you're married and both of you are 65 or older, that's potentially $12,000 in additional deductions that could meaningfully lower what you owe, or increase your refund. This is a newer provision, and a lot of seniors are simply not aware it exists. Make sure you or your tax preparer are claiming it when you file. Now, I want to take a moment here to speak to you heart to heart, because I know that for some of you, all of this can feel a little stressful. Maybe you're thinking, I don't have a financial advisor, or I'm not sure I've been doing this right. Please don't panic. The fact that you're watching this video right now means you're doing something right, you're staying informed, you're paying attention, and you care about making smart decisions. That matters enormously. If you believe you fall into the category of someone who turned 73 in 2025 and hasn't yet taken your first RMD, the most important step is simply to contact your IRA custodian or 401(k) plan administrator as soon as possible. They are required to help you calculate and process your RMD, and in many cases, they'll even have the calculation already done for you. If you're unsure about the tax implications or whether strategies like a QCD make sense for your situation, a consultation with a CPA or a fee-only financial planner can be worth every penny. Think of it as an investment in protecting the retirement you've spent a lifetime building. And for those of you who are perhaps watching this on behalf of a parent, a sibling, or a friend who turned 73 last year, please share this video with them. Print out a note if you need to. Make a phone call. Sometimes the most loving thing we can do for the people we care about is to make sure they have the information they need before a costly deadline slips by. As we begin to wrap up today's conversation, I want you to feel empowered, not overwhelmed. You now know who this April deadline affects, how to calculate the amount you need to withdraw, the pitfalls of waiting too long and triggering a double distribution, the freedom that Roth IRAs provide, the beautiful giving strategy of a QCD, and the new senior deduction available when you file your taxes this April. That's a lot of powerful knowledge, and you should feel proud for taking the time to learn it. Coming up next, we're going to talk about what happens after you take your RMD, specifically, smart ways to use or reinvest that money so it keeps working for you even after it leaves your retirement account. You might be surprised at how many options you actually have, and some of them are simpler than you'd ever expect.